Good morning, everyone. Thank you so much for joining us for the Colorado Fiscal Institute's webinar on the federal tax bill. Really quick before we get started, I'm going to introduce our Executive Director, Carol Hedges, who's going to give a quick intro. But can I ask that everyone make sure that their microphone is muted on your computer or your phone so we don't get any crossover audio. Thank you so much, and here's Carol Hedges.
Good morning, everybody. Thanks so much for joining us. We are really proud and pleased to be able to present, we're using all this cool technology and stuff to connect with folks who may or may not have had an opportunity to hear the presentation on the Tax Cuts and Job Act. I'm really thrilled that Elizabeth Cheever and Esther Tercios are going to be able to do this presentation for us today. We have been spending a lot of time trying to understand what the federal tax bill is going to mean for taxpayers in Colorado, and importantly, for what it's going to mean for the state of Colorado in terms of our ability to collectively provide services that keep our communities strong and thriving. I just wanted to say welcome this morning, and if there's any other places that you think we would be welcome to come and talk about this issue, or organizations or people that would like to hear about it, please reach out and let us know, because it's important that we all understand and get on the same page about the provisions of this federal bill. And further, I think it's really important, as you're going to be learning from Esther and Elizabeth today, that there is so much still undetermined about the impact, particularly on the state budget, that we should move with some caution going forward with assumptions about what it's going to mean, because as taxpayers' behavior changes dramatically based upon the incentives that are in the tax code, and we haven't sorted all that out, and there hasn't been an opportunity yet for everybody to play that out. So with that bit of introduction, I want to thank you again for joining us. If you do have people, other organizations that would like to hear this information, please just reach out through the chat room or email us through our website, and we would love to schedule an in-person presentation for you. So I'm going to step away and turn this over to Elizabeth and Esther.
Thanks, Carol.
Good morning, everyone. This is Esther Tercios. Once again, thank you all for joining us on our federal tax webinar this morning. A few housekeeping items before we jump in. We have built in time to answer questions throughout the webinar. You can chat questions to us at any time in the chat box, and we will answer them during the question break. Please make sure, as Elizabeth said, that your audio is muted. And we just want to let everyone know that we will be making these slides available via email and on our website after the webinar. Thanks again for joining us, and we will jump right in.
Thanks, Esther. And this is Elizabeth for those of you who don't know. So we've split this presentation up into 3 parts. First, we're going to go over the changes made to individual income taxes under this law, under the Tax Cuts and Jobs Act, and their implications. Then we'll review changes to corporate and business taxes. And finally, we'll take a look at Colorado's budget and what the TCJA means for spending in our state particularly. So a couple of things. The impact of the federal tax cut bill on Colorado taxpayers and our state budget. The estimates we have, the total federal tax reduction for Coloradans, the tax cut that Coloradans will see under this bill, is $6.3 billion in cut in federal taxes. 51% of those tax cuts go to the top 5% of earners in Colorado, and 5% of those cuts go to the bottom 40% of Colorado earners. A note is that different provisions affect taxpayers differently. We won't be able to comment on specific tax situations. This is a general assessment of what this means for Coloradans, but of course everyone's tax situation is different. The total net state revenue increase, the revenue that Colorado will see, the additional revenue Colorado will see because of this tax cut of the tax bill is $28 million. And a note also is that estimates about this revenue increase vary based on the assumptions you make about taxpayer behavior. So the Colorado Legislative Council has also come out with an estimate for the revenue increase Colorado will see, and that's closer to 250 or 300 million. That's and the 28 million we're using is from the Institute on Taxation and Economic Policy. That's a huge variation in this possible revenue that Colorado could see under the TCJA, and that but it's really reasonable given how many variables there are here. So Legislative Council's methodology is sound, and we trust what they're looking at, as well as the Institute on Taxation and Economic Policy. But the bottom line mostly is that the revenue Colorado will see, we're really not sure what that number is going to look like. And so in terms of making state spending decisions based on how much revenue we think we might see, CFI is recommending that we be conservative with those spending. So we'd like to explain quickly why Colorado is going to see additional tax revenue under the TCJA when the federal government is going to see a significant decrease in revenue. This is an overview of essentially how federal and state taxes are calculated. So federal taxable income is the dollar number that is subject to taxation under federal tax rates. So FTI is calculated using a number of variables, and under the Tax Cuts and Jobs Act, federal taxable income is actually going to be larger. So more dollars will be subject to taxation. However, because federal tax rates are now lower, the federal government is going to see a lower net revenue. So FTI is larger, but tax rates are smaller, and so as a result, the federal government sees less revenue. Colorado uses federal taxable income. It's one of the few states that does use federal taxable income to calculate state taxes. But because the Colorado tax rate is unchanged, Colorado will be expected to see an increase in net revenue because, again, that FTI number has increased. It will be larger for every taxpayer, but our rates haven't changed.
As Elizabeth stated, the reason why the federal government will see a reduction in revenue is because the tax brackets have been lowered. As you can see here, under the TCJA, the 7 tax brackets were retained, but overall the tax rates have been reduced. So again, larger FTI, but smaller rates. In order to better understand what changes did and didn't make it into the new tax law, we want to make sure folks understand where within the FTI calculations the changes will occur. Before we get to federal taxable income, we first start with our total gross income and subtract above the line deductions from this number. There was a lot of debate in the House and Senate as to what would be changed in above the line deductions, but the final TCJA law kept the educator expense deduction, which was a big win for teachers, and it did preserve the student loan interest deduction. There were a few changes, such as the elimination of alimony and moving expense deductions, but overall, AGI calculations under the TCJA didn't change much. From adjusted gross income, we then get into standard and itemized deductions, where we see that the biggest changes occurred. Most people take the standard deduction when they don't have many things to itemize, and what tends to push someone into itemizing is really owning a home, because as you can see, you can deduct your mortgage interest deductions, and you can also deduct charitable contributions you make, state and local taxes you pay, among many other things that you can itemize. Under the TCJA, the standard deduction has been doubled for both single filers and couples. And because of this doubling of the standard deduction, it's assumed that more people will take the standard deduction instead of itemized, because, and Elizabeth will go into this next, most itemized deductions have been either repealed or greatly reduced. And like I said, Elizabeth will go into more detail about itemized deductions. The overall doubling of the standard deduction will decrease the state revenue by over $500 million. And to get a better picture of the impact of the changes to the standard deduction, we have the following scenario. So a household making an average of $34,000 a year will see an average tax cut of $255, while a household making an average of $1 million a year will see an average tax cut of $761. So overall, this change will be very costly to the state, and it will largely benefit wealthier households.
Thanks, Esther. It looks like we don't have any questions yet. Again, feel free to type any questions you have into the chat box, and we'll also have more time later in the presentation for questions. So let's look at the changes that the Tax Cuts and Jobs Act have made to itemized deductions. For those taxpayers who still itemize, and there will be fewer, as Esther said, because the standard deduction has doubled, the TCJA has made changes to a number of itemized deductions. So the state and local tax deduction, under previous law, you were able to deduct any state and local taxes paid. That really matters for residents of high tax states, think New Jersey, New York, California. Now, under the TCJA, the total state and local tax deduction is capped at $10,000. Again, that's not a huge impact for Coloradans because we're a fairly low tax state, and so not many people were deducting more than $10,000 in SALT deductions. The mortgage interest deduction has also changed. Taxpayers can deduct interest payments on up to $750,000 of debt. Under previous law, taxpayers were able to deduct interest payments on up to $1 million of mortgage debt. The medical expenses deduction has actually been expanded. So under previous law, individuals were able to deduct any medical expenses that exceeded 10% of their income. Now taxpayers can deduct any expenses over 7.5% of their income or their AGI. Under previous law, the value of your itemized deductions was limited if your income exceeded a certain threshold. So under prior law, your ability to deduct itemized deductions was phased out to some extent, starting at if you were filing singly, $266,000, and if you were filing as a couple, if your income was over $320,000. That limit has been repealed entirely, so there's now no income limit on the amount of itemized deductions that can be taken for wealthy people. There are also changes we're seeing under the TCJA to personal exemptions and family credits, and this is really where we're seeing some of the biggest changes under this new tax law. So exemptions reduce your federal taxable income, and credits reduce the amount you actually owe or your tax liability. So under previous law, exemptions could be taken for every member of your household. So in this example we have on this slide, an exemption for a family with 3 children. An exemption could be taken for yourself, your spouse, and each of your dependents. And that's actually even if they weren't children. So for example, if you had adult children dependents or elderly relatives who are dependent on you, you could take an exemption of $4,150, which essentially reduced your federal taxable income by that exemption amount, that $4,000. Under the Tax Cuts and Jobs Act, all of these exemptions have been eliminated. So that's part of the reason why FTI is so much larger and why Colorado will see increased tax revenue, which is what I talked about at the beginning of this presentation. So there are no longer those $4,150 deductions for every member of a family. The TCJA attempts to offset this change by doubling the child tax credit. So the child tax credit has doubled from $1,000 per child to $2,000 per child. So it's important to note that the refundable portion of the child tax credit, which a lot of low-income families rely on, goes up to only $1,400. So no matter how many children you have, that refundable portion is only $1,400. The child tax credit is also no longer available to parents who claim for children without a Social Security number. There's also a $500 credit for non-child dependents. So those people for whom you would be able to you would have been able to take an exemption for under prior law, adult children, elderly relatives, other dependents. There's now a $500 credit for those individuals. What does this mean for Colorado? So the changes to personal exemptions, and again, this is one of the biggest changes made in this law, overall increases state tax revenue by $861 million. So the state will see that much more in revenue because of these specific changes. For a household making $34,000 a year, that means an increase in their taxes of about $247. For a household making around $1 million a year, we're looking at an average of a $195 tax increase. So there were so many iterations of the Tax Cuts and Jobs Act, and it's really important to clarify that some of the highly publicized changes that were in earlier versions of the bill did not make it into the final bill. The TCJA does not treat graduate tuition waivers as income. This would have made it unaffordable for a lot of grad students to go to school, but it was taken out of the final version. The TCJA also does not eliminate the charitable contribution deduction. As Esther discussed earlier, the doubling of the standard deduction likely means that fewer people will itemize, and therefore that means that fewer people will be eligible for the charitable contribution deduction, but it is retained. The TCJA also does not eliminate the medical expense deduction. In fact, as we talked about when we looked at itemized deductions, it expands that deduction to more people. And I'll hand it over to Esther.
Yeah. On the flip side of that, we do want to talk about what the new tax law did do. It did repeal the ACA individual mandate beginning in 2019. This will really destabilize the market, and it will mean approximately 13 million fewer Americans are uninsured. It also expanded the use of 529 savings accounts. Previously, these accounts were used to pay for higher education-related expenses, but under the new tax law, these savings can be used to pay for K-12 private school tuition expenses. It also increased the alternative minimum tax exemption, which operates alongside the regular income tax, and it requires many taxpayers to calculate their liability twice. So once under the rules for regular income tax and once under the A&T rules, and then they pay the higher of the two amounts. It affects roughly only 5 million filers, and now with the higher exemption, it means even fewer people will pay it. It restricts natural disaster deductions to losses incurred only when the president declares a disaster area. And finally, it eliminates the tax incentives that private employers get when they subsidize their employees' commuting expenses, which includes commuting via transit or like RTD, parking, and any biking expenses that their employees incur. So
Now,
with that, we'll take another little break here. Elizabeth, it looks like we do have a question. What is the time frame for that net state revenue increase over how many years?
that's a great question, and I am looking up the answer right now. I believe that net state revenue increase is as of 2025. We will confirm that, and we can answer that at the end of the presentation. Thank you for that question. It's a great one.
And we have another question that just came in. Does the change to personal exemptions change how people claim dependents?
Another great question. So it will change who is and is not a dependent. Our understanding is that because the child tax credit has been doubled, people will still claim their children as dependents. If your question is, how does someone qualify as a dependent, my understanding is that those parameters don't change, what makes someone a dependent or not, but it does change how a dependent affects your federal taxable income. Any more questions?
Not so far. Let's take a few more minutes in case any other folks want to type in some questions.
Great. All right, so we will keep going, and there will be more breaks for questions. We love questions, so we always want to take them. All right, so let's move on to business taxes. That was our overview of how the Tax Cuts and Jobs Act changes individual income tax filing. There are also big changes on the business tax level. So for tax purposes, businesses are classified into two categories: pass-through entities and corporations. 95% of the businesses in the United States are classified as pass-through entities, and they're called pass-throughs because before the TCJA, business income essentially passed through or was taxed as part of a business owner's individual income taxes. So any business income was taxed at those individual income rates, those brackets that we looked at the beginning of the slide deck, those 7 individual brackets. Under the Tax Cuts and Jobs Act, pass-through income is no longer taxed alongside individual income or at individual income rates. The new tax law creates a 20% deduction for all pass-through business income. There are a few implications. In particular, this benefits capital-intensive businesses like real estate investment or venture capital. There have also been big changes made to corporate taxes. So corporations are those businesses which aren't pass-through entities, that other 5% of American businesses. So think Walmart, Boeing, very large businesses with more than 100 shareholders. The corporate tax rate has been lowered under the new tax law from 35% to 21%. Another thing to note is that the business tax cuts, everything outlined on this slide, are permanent. And the individual income tax cuts, all the cuts for people like you and I, which we discussed in the individual section, expire after 2025. So what are the impacts of these pass-through changes on Colorado? And we don't have individual impacts for corporate taxes because those don't really affect individual families per se in a way that's measurable. As we did before, we've broken down how these tax changes affect Colorado families at different income levels. This slide is a little bit different than the other two effect slides that we saw because not many Coloradans file taxes with pass-through income. So these are the changes for that 16% of Coloradans who will see a tax cut under the pass-through changes. And of those seeing a cut, a family earning $34,000 would see $81 back in their pocket, an $81 tax cut, and a household earning $1 million would see a $2,760 tax cut on average, so that much more back in their pocket. The pass-through changes decrease state revenue by $223 million. So I'll hand it over to Esther to talk about repatriation, which is good stuff.
Yeah. So another way that big businesses will benefit under the new tax law is through repatriation taxation. So currently, U.S. companies pay taxes only on the profits they earn in the U.S. So a lot of these companies use accounting loopholes that allow them to keep their profits offshore where they don't have to pay taxes, and they only do so when they bring those profits back into the U.S. And under the new TCJA, they will allow a one-time repatriation tax holiday where these companies will be able to bring those offshore profits back into the U.S. at a low rate of 8%. And the argument behind a repatriation tax holiday is that bringing those past profits back into the U.S., those companies will reinvest that money back into the workforce, and it will help stimulate our economy. And we've actually done this before. In 2004, large U.S. companies were able to repatriate offshore profits at a really low rate of 5.25%. And of all the companies that were eligible to partake in this, 843 took advantage of this tax holiday and brought back over $300 billion worth of earnings, and which was about a third of the total cash that was held offshore. And we actually learned a lot from this experience that repatriating profits didn't work as intended, and in fact, it didn't stimulate the economy. And even worse, 5 of the biggest companies, Merck, Pfizer, HP, Johnson and Johnson, and IBM, who brought back most of those shares, ended up slashing thousands of jobs, and most of their money, almost about 91 cents to the dollar, went to pay for share buybacks and dividend payments. So basically, to make the shareholders of these companies even richer. So we've learned from previous experiences that this doesn't work and it doesn't stimulate our economy.
So we've got questions, question time built in here. If we've got any more questions about repatriation or business tax changes, we're happy to take them. And there will be more time at the end of the presentation. Thanks. So what does this mean overall to Colorado taxpayers? The net impact here is that the top 5% of Colorado taxpayers receive 52% of the tax cuts under the TCJA. On the top 20% receive 73% of the tax cuts under this law, and the bottom 40% of Colorado earners receive 5% of the tax cuts. So that's just to give you a sense of the net effect. How does this affect the federal deficit? This has been widely publicized. I'm sure you've heard it. This is going to add $1.5 trillion to the federal deficit. So the tax cuts are taking a lot out of the federal deficit, and that means that that the government has to find a way to make up for that dearth. So how do we pay for these cuts? Where we can expect these cuts to come from, and we don't have solid information on this yet because they haven't made moves on this yet in Washington, but we can expect a lot of the cuts to come from entitlement programs, things like Medicare, Social Security, and Medicaid. Cuts might come from defense, depending on the decisions made in DC, and non-defense discretionary spending. We'll also likely see budget cuts in order to pay for this $1.5 trillion increase to the deficit. And so to put that in context, what does that mean for Colorado? And Esther will talk about what that means for us.
Yeah, so in order to truly understand how Colorado's budget will be affected by these changes, we need to take a closer look at the makeup of our budget. So Colorado's budget is about $29 billion, and it can be divided into 3 main pots of money. About a third of our budget is federal funds, which are dollars we get from the federal government for specific purposes, such as Medicaid dollars. The next third of our pie of our budget is cash funds, and think fees paid for specific purposes. So for instance, we pay motor vehicle registration fees, which are then used to pay for our roads and our bridges and our highways. If you're an attorney, you pay attorney's fees, and then those dollars are used to pay for our courts. So as you can see, 2/3 of our funds are dollars that already have designated purposes, which brings us to our last slice of the pie, which is our general fund. And this is a fund that pays for everything else that we think of. So schools, higher education, prisons, and it's the fund that our legislators have the most discretion over. As you can see, a large portion of our budget is federal funds, and any changes to either of these pots has a big effect on our general fund. Also, because of our constitutional budget constraints, we don't have the ability to raise taxes easily to offset any changes that we may see to our federal fund.
I'm going to jump in here. We're getting some weird notifications from Zoom, and so we might have a technical issue. So just a heads up, if the webinar ends early, we will follow up with everyone by email, and apologies for that. But we hope nothing happens. Esther, going. Sorry for the interruption.
No problem. And if we take a closer look at our general fund, we see that most of our dollars go to pay for K through 12 education. We then have healthcare, which is mostly traditional Medicaid dollars. We have public safety, so think prisons. We have higher education, human services, so think child welfare, community mental health centers, our courts, public health, and other programs. So again, any changes to other pots of money ultimately means cuts to the programs that we care about, and without the ability to grow the size of the pie because of favor restrictions, it's difficult for us to take any hits in any other slices of our pie. So the bottom line is that each taxpayer situation is different. You saw from previous slides that the amount of taxes that each Coloradan will owe is going to vary significantly, but we know that overall we will be affected by the changes in federal support. And because of our unique constitutional budget constraints, our ability to support public investments will become even more of a challenge.
Thank you so much. So we've got a couple more questions here that I'll read out. So Esther, you mentioned that the individual tax cuts will expire. Will the individual exemptions go back to the way that they were?
Yes. So once the individual tax cuts will expire, we're assuming that they will go back to the original rates that we see today, pre-TCJA.
Feel free to chat any other questions to us. And thank you so much for joining. We're always happy to connect with fellow tax nerds because we like to talk about this all the time.